Hey, today I want to tell you a story about the single best investment I ever made as a hedge fund manager. And it's a story about how a $100,000 investment when I first started my hedge fund turned into over $1.9 million today. And that investment was in a burrito company back in 2010 that became an 18-bagger. And the company, of course, was Chipotle. I first bought this company in 2010, and it is actually still in our portfolio today. And I first discovered this company in the best way possible, by personal experience. I was at the time working in downtown San Francisco, and there was a location for Chipotle on Market Street in San Francisco, and it was absolutely packed. There were lines out the door with business people during the lunch rush, and it's hard to imagine today, but back then, fast casual wasn't a common term. When Chipotle was first spun out of McDonald's in 2006, it had about 500 stores, and it was, quote, fast food. But over time, it became known as fast casual. Just for comparison, today, Chipotle has over 3,700 locations worldwide, so massive growth. I want to talk a little bit about the founder of Chipotle. Back when Chipotle was just a small restaurant with a couple of locations, it was founded by a guy named Steve Ells, and he wasn't a typical fast food guy. And this will kind of give you the context to explain why Chipotle was able to create a whole new class of restaurants called fast casual. He was a chef trained at the prestigious Culinary Institute of America, and he had this idea of applying traditional French cooking techniques to American cooking. The food at Chipotle was different. It was acquired by McDonald's. The food was fresh. So that was initially what gave me the idea to potentially invest in this company. But I also looked at the fundamentals, and the story, the business story, was just as exciting and confirmed what I thought would be the case, that this was something really special. In 2010, the revenues were growing at over 20% a year, and the company had no debt. More importantly, from a valuation perspective, the stock was trading at a PE ratio of between 30 and 40, so that wasn't inexpensive at the time. But back in the day, I was trying to find companies where the PE ratio was no more than 1 or 2 times the annual growth rate of earnings. And so Chipotle definitely met that criteria, and we went all in on this company. It was one of my first investments as a hedge fund manager. We had a pretty small portfolio at the time, and back then the stock was trading for just $3 or $4. Today, just for context, it's trading at $56. So that'll give you a sense of just how big of a success this was. But even though the investment over the course of 15 years was a rocket ship, there was lots of drama. Back in 2015, there was a major crisis, and there was an E. coli outbreak at Chipotle, and it started in the Pacific Northwest and then spread through many stores. And many stores were temporarily closed because people were getting sick. The CDC linked 2 separate outbreaks to the company, so this was a nightmare from a stock investor's perspective. The stock had been trading at a high of about $15 and went to a free fall. We watched it day after day, plummeting as the media hammered this company. And what was really, really difficult about this is that Chipotle's brand had become toxic overnight. And it went from a company that was known for serving super fresh food, their motto was food with integrity, to something that was very, very inconsistent with that brand, something that was dangerous and unsafe. And so lots of people were wondering whether this was the end of the Chipotle growth story. But from my perspective, having quite a bit of training from reading Warren Buffett and Charlie Munger, even though a common instinct is to sell and to run for the hills, we asked ourselves, did we continue to believe in the long-term story? And I remember very distinctly doing the research and spending weeks underwriting our research and why we bought the company in the first place. I also looked at the history of other restaurant chains that had faced major health-related public relations crises. I remember studying Wendy's. They had a situation in 2005 where apparently a severed finger was found in a chili at one of the restaurants. That turned out to be a hoax, but the brand damage was real. I remember also Jack in the Box, or where, somebody got sick, or I believe even somebody died as a result of eating some food there. And I found a pattern, and the pattern was that this was absolutely negative for the stock price, but over time, these brands recovered. So what I did is I did something that was very counterintuitive. Other people were fearful. I ended up buying more shares of Chipotle at around $5 or $6. And this was pretty nerve-wracking because after increasing our position in Chipotle, the price of the stock actually went down to about $5. So you can imagine as a percentage, the stock had gone down, 50, 60, 70%, and then kept going down even after I bought more. The turning point was when the company started to, figure out what happened. It was a supplier problem. And they also brought in a new CEO, a guy by the name of Brian Niccol. And this was in 2018. And the market was incredibly optimistic about Brian. And for good reason. He had been the CEO of Taco Bell, and he had engineered a massive turnaround, making the brand culturally relevant, and kind of cool. And the hope by investors was that this guy could bring the same innovative energy to Chipotle and a fresh marketing approach. Under Niccol's leadership, Chipotle made a spectacular recovery. The stock didn't just recover, it soared to all-time highs, far beyond its pre-crisis peak. And my decision to buy Chipotle stock during the darkest days of the company's history paid off immensely. Today, Chipotle is a global powerhouse. It's a company that has completely changed the restaurant industry. It's paved the way for a new generation of fast casual brands like Panera Bread, Shake Shack, Sweetgreen, and Cava. I want to leave you with 3 key lessons that I learned from investing in Chipotle. The first one is you have to find disruptors. Find companies that are doing things that are different, that are strong, and are backed up by fundamentals. You buy those companies, and of course you have to wait, sometimes years or even a decade, but that's where the real money is made. And just as a reminder, this was an 18-bagger for me and my hedge fund. Lesson 2 is that crisis is potentially opportunity. It's not a time to panic. The reality is that if the long-term fundamentals remain strong, a crisis can be an incredible opportunity to buy more. And number 3, and this is a lesson I'm still honestly continue to hone and master and learn, we have to embrace volatility. Even the best companies, whether it's Chipotle or Apple or Google, are full of drama and stomach-churning volatility. You look at the long-term stock price of any of these amazing companies. If you had the conviction to hold on and even potentially add on when there was this stomach-churning volatility and the stocks hit lows, those were the moments that separated the great investors from the mediocre ones, but separated a good investment from a great investment. So my final thought and takeaway from my experience investing in Chipotle is that Chipotle was more than just about burritos, and it's more than just about trading. I think that it was arguably the best application of the lessons of masters like Peter Lynch and Warren Buffett and Charlie Munger to buy great companies, to ignore short-term stock fluctuations, and to be greedy when other people are fearful, and to be fearful when other people are greedy. Thanks for watching.